Hey everyone, welcome back to Corporate Decoder. Today, Profusa Incorporated just filed an 8K report about a major deal, and I am seeing some interesting moves being made. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is essentially grabbing an option to buy a diagnostics company, and they are paying for that option with stock. Let's dive into what this filing is all about. It looks like Profusa Incorporated, or Profusa as they call themselves, has entered into an option agreement. Think of it like a down payment on a future acquisition. They have the right, but not the obligation, to buy all the shares of another company called G3 Vision Labs Incorporated. This isn't just any company though. G3 Vision Labs Incorporated apparently owns or controls a few other businesses: MedScreen Laboratories Incorporated, Dominion Diagnostics LLC, and Acutus Diagnostics Incorporated. If Profusa decides to go through with this and exercises their option, these three companies will become subsidiaries of Profusa. The key date here is the 31st of July 2026. That is when this option agreement was signed. Profusa is paying for this option with their own stock. They issued two types of stock to the sellers of G3 Vision Labs Incorporated. First, they gave out a total of 201,120 shares of their common stock. Second, they issued a chunk of something called Series and Non-Voting Convertible Preferred Stock. This is a new kind of preferred stock they created specifically for this deal. Now, this series of preferred stock is pretty interesting. Each share can be converted into 1,000 shares of Profusa's common stock. That is a lot of potential dilution down the road, but it is contingent on getting approval from Profusa's shareholders, if Profusa decides to exercise their option to buy G3 Vision Labs Incorporated. The sellers will get even more of this series, a preferred stock. This option doesn't last forever. It expires 90 days after the company's being acquired provides certain financial information. For Profusa to actually go through with the purchase, several conditions need to be met. They need to secure at least $30 million in new financing, either for themselves or for G3 Vision Labs Incorporated. They also need to sort out some debt related to G3 Vision Labs Incorporated. Plus, their shareholders need to approve a few things, including the conversion of this new series of preferred stock into common stock, and the overall acquisition deal itself. They also need to keep their stock listed on the NASDAQ Stock Market LLC. Speaking of NASDAQ, Profusa's common stock is traded under the symbol PFSA on the NASDAQ Stock Market LLC. It's good to see they are actively trying to maintain their listing status, especially given some of the challenges smaller companies can face. Profusa is also checking the box as an emerging growth company. This means they can take advantage of some relaxed regulations, but it also suggests they are still in a relatively early stage of their development. The stock they issued as part of this option deal was not registered with the SEC. They are relying on an exemption for private placements, which basically means they believe the sellers are sophisticated investors who understand the risks involved. Each seller has represented that they are an accredited investor and are buying these shares for investment purposes only, not to quickly resell them. This is standard practice for these types of deals. As part of this deal, Profusa had to file a certificate of designation for their new series of preferred stock with the state of Delaware. This document lays out all the rights and rules for this preferred stock. Importantly, it states that holders of this series of preferred stock generally don't have voting rights, except in specific situations where their rights might be negatively affected. They have the right to dividends similar to common stock, but the real power comes from their potential conversion into common stock. The automatic conversion of the series of preferred stock into common stock will happen 3 business days after shareholders approve it. However, there is a catch. A holder of this preferred stock can't convert their shares if doing so would make them, along with their affiliates, own more than a certain percentage of Profusa's total common stock. This percentage can be between 4.9% and 19.9%, and the holder gets to choose. This is a way to prevent any single investor from gaining too much control too quickly through this conversion. Here is something interesting that could affect their stock listing. Profusa believes that after issuing these stocks, they now have at least $2.5 million in stockholders' equity. This is important because NASDAQ has a rule that requires companies to meet certain equity or market value thresholds to stay listed. This equity standard is an alternative to a higher market value requirement. They are waiting for NASDAQ's official confirmation that they meet this rule. This is a crucial point for the company's future trading status. It's worth noting that Profusa announced a CEO change recently with plans to acquire a $111 million diagnostics company. This filing seems to be the next step in that strategic move. The headline about the CEO change and acquisition plans did mention acquiring a $111 million company. But this option agreement is for G3 Vision Labs Incorporated and its subsidiaries, not explicitly stated as $111 million in this filing. It does, however, show that Profusa is very active in pursuing growth. So, what is my take on this? Profusa is making a significant move to expand its business by gaining control of G3 Vision Labs Incorporated and its related companies. They are using stock as currency for this option, which can lead to dilution for existing shareholders if the option is exercised and the preferred stock converts. The conditions for exercising the option, especially the financing requirement of $30 million and shareholder approval, are key hurdles. The most pressing issue right now seems to be their compliance with NVACW listing rules, and they are betting that the equity they've issued will get them over that hump. The risk I am watching is whether they can secure the necessary financing and shareholder approvals, and how much dilution will ultimately hit the common stock if this deal goes through. What I am actually looking for is confirmation from NASDAQ about their listing status. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives and check out the Discord in the description.